before we dive into the abyss of red numbers and shattered expectations, I need you to do something for me right now. Hit that subscribe button and ring the notification bell, because what I'm about to reveal isn't just another piece of crypto news. It's a fundamental crack in a narrative that we've all been sold, a story of seasonal patterns breaking down that could signal a tectonic shift in the entire digital asset landscape. And you need to be on the front lines with me as we decode what this truly means for your portfolio. The headline is stark and, for many, deeply unsettling. According to a comprehensive data analysis from Coinglass, Bitcoin's performance for the month of November has clocked in at a negative 12.39%. Now, on its own, a down month in crypto is about as surprising as a rainy day in London. It's the volatility we all signed up for. But the real story, the one that should make every single investor pause and reevaluate their entire understanding of market cycles, is found in the brutal contrast with history. You see, November isn't supposed to be a down month. Far from it. Historically, November has been Bitcoin's golden child, its powerhouse month. The average return for November, based on over a decade of data, is a staggering, almost unbelievable positive 42.49%. Let that number sink in for a moment. Positive 42%. That's the historical precedent. That's the ghost now haunting this current chart. So, we are not looking at a mild underperformance. We are staring down a deviation of nearly 55 percentage points from the historical mean. This isn't a dip, it's a structural anomaly. This single data point from Coinglass is more than a statistic. It's a flashing red siren forcing us to ask a very uncomfortable question. What in the world has changed? Is this just a temporary blip, a footnote in the long-term bull run? Or is it the first hard evidence of a new, more pessimistic reality taking hold? To understand that, we have to peel back the layers and look at what makes November traditionally so strong. For years, the narrative has been tightly woven around a concept known as the Santa Rally, but it starts in November. The theory goes that as the year winds down, institutional investors, hedge funds, and even retail traders begin positioning themselves for the new year. There's a sense of optimism, a risk-on mentality that permeates the markets as people look forward to a fresh start. Capital flows in, and for Bitcoin, with its fixed supply, that influx of demand has historically created explosive upward pressure. Furthermore, November often serves as a consolidation period after the potential volatility of September and October, which have their own mixed reputations. It was a calm before the storm of December gains, a steady, reliable engine of growth. This year, that engine has not just sputtered, it has thrown a rod. So, what killed the November effect? The immediate suspects are, of course, the macroeconomic winds that are blowing with hurricane force intensity. We are living in an era of quantitative tightening, not easing. The Federal Reserve and other central banks are not injecting liquidity. They are actively sucking it out of the system at a historic pace. For a speculative, high-risk, high-liquidity dependent asset like Bitcoin, this is a direct headwind of monumental proportions. The cheap money that fueled the epic runs of years past is gone, replaced by the most expensive borrowing costs we've seen in over 2 decades. This doesn't just affect leveraged crypto traders. It affects every large institution that might have considered Bitcoin as a viable allocation. When your cost of capital is 5% plus, the opportunity cost of parking funds in a volatile, non-yielding asset becomes a very difficult calculation. Then, layer on the specific crypto-native events that have cast a long shadow. The lingering trauma from the collapses of 2022, the ongoing regulatory battles with entities like the SEC, creating a fog of uncertainty, and the sheer exhaustion from a multi-year roller coaster have all contributed to a crisis of conviction. The narrative of digital gold and inflation hedge was severely tested during the last inflationary spike, and for many, it failed that test, correlating more with tech stocks than with a safe haven asset. This has left Bitcoin in an identity crisis, caught between its original cypherpunk ideals and its aspirations of being a mainstream financial instrument. The data from Coinglass is the quantitative proof of this qualitative shift in sentiment. The seasonal pattern, a cornerstone of many trading strategies, has broken. And when a pattern this reliable breaks, it tells you that the underlying fundamentals of the game have changed. It tells you that the old maps are no longer reliable for navigating this new, more complex, and more hostile financial terrain. So, if the old playbook is obsolete, if the historical patterns we relied upon are crumbling, then the critical task for every single one of us is to stop looking backward for answers and start building a new framework for understanding what comes next, a framework built not on seasonal hopes but on the cold, hard realities of on-chain data, macroeconomic pressure, and a global liquidity landscape that has fundamentally shifted against the speculative excesses of the past decade. The negative 12.39% return isn't just a number. It's a symptom of this new era, and to diagnose the patient's future health, we need to look beyond the price chart and into the very plumbing of the Bitcoin network itself. Let's start with the on-chain metrics, the undeniable truth of the blockchain that cuts through the noise of sentiment and speculation. If we examine the data surrounding the November sell-off, a telling story emerges. One of the most crucial indicators, the spent output profit ratio, or SOPR, which tells us whether coins being moved are being sold at profit or a loss, has been consistently hovering in negative or barely break-even territory. This indicates that a significant portion of the selling pressure is not coming from profit takers, but from investors capitulating and selling at a loss. This is a classic sign of a bear market structure, where weak hands are being shaken out, but the critical question is, who is on the other side buying these coins? The answer lies in the behavior of long-term holders. Analysis of the hodler net position chain shows that while short-term speculators have been net distributors, entities holding Bitcoin for over a year have, in aggregate, been accumulating or holding steady. This creates a fascinating and tense standoff. The market is in a state of redistribution, where coins are being transferred from impatient, leveraged short-term traders to patient, conviction-driven long-term believers. This is a painful but necessary process for any asset to build a solid foundation for its next leg up. However, this internal transfer of assets is happening against a brutal external backdrop. The macro environment is no longer a supportive tailwind. It's a dominant, overwhelming headwind. The era of free money is over, and we are now in the era of money with a cost. This simple shift changes everything for an asset like Bitcoin. When risk-free assets like U.S. Treasury bonds are offering yields north of 5%, the calculus for any institutional portfolio manager becomes incredibly difficult. Why take on the immense volatility and regulatory risk of Bitcoin when you can get a guaranteed, handsome return from the U.S. government? This is not a fleeting sentiment. This is a fundamental repricing of the entire global financial system. The high correlation between Bitcoin and U.S. tech stocks, particularly the NASDAQ, throughout this period further cements this reality. Bitcoin is not yet trading as the uncorrelated, macro-independent asset its proponents hope for. It is acting as a high beta, risk-on tech stock, and in a climate of sustained high interest rates and quantitative tightening. That is a very difficult place to be. This brings us to final, and perhaps most important, implication of this November anomaly: the death of blind seasonal trading. For years, traders could simply buy the October dip in anticipation of the November pump. That strategy, based purely on calendar history, has been eviscerated. The market has matured, or perhaps been corrupted, to a point where external macro forces now trump internal seasonal patterns. This doesn't mean seasonal effects will never return, but it does mean they can no longer be your primary thesis. Your investment strategy must now be built on a deeper analysis of Federal Reserve policy, global liquidity measures, inflation trajectories, and the stark, unemotional signals from the blockchain itself. The minus 12.39% November is a wake-up call. It's the market's way of telling us that the easy money has been made and that the road ahead requires more sophistication, more patience, and a much higher tolerance for pain. The speculative froth is being washed away, and what remains will be a leaner, more resilient network. But getting to that point will be a journey of volatility that will test the conviction of every single person watching this. The pattern is broken. The question is, are you prepared to trade in a world without it? Now, I want to hear from you. This is a complex and critical moment for the entire crypto space, and your perspective is invaluable. What is your primary takeaway from this historic deviation from Bitcoin's seasonal pattern? Do you see this as a temporary anomaly or a permanent regime change? And most importantly, how are you adjusting your own strategy in response? Let me know your thoughts, your questions, and your biggest concerns in the comments below. The most insightful comments will be featured in our follow-up community post. And if this deep dive into the data has helped you see the market in a new light, if you believe in cutting to the hype to get to the hard truths, then do this channel a massive favor. Smash that like button, share this video with one person who needs to see this analysis, and subscribe for the clear-eyed, data-driven guidance you won't find anywhere else. The patterns are broken, but our mission to understand what comes next is just getting started.